You have probably seen the videos, influencers telling you to become your own banker using life insurance. But if you execute this viral trend in Canada, you are walking straight into a Canada Revenue Agency tax audit. The pitch goes like this. You overfund a permanent life insurance policy, build up a massive cash value, and then take tax-free loans out against your own money. It sounds like the ultimate financial cheat code. You bypass the traditional banks, retain total control of your capital, and keep the government entirely out. There is a massive geographic blind spot in this advice. The infinite banking concept relies entirely on specific loopholes written into the United States tax code. Financial strategies do not cross borders cleanly. When you import a highly technical tax maneuver without running it through local laws, the mechanics break down. Applying American infinite banking rules to a Canadian insurance policy is a catastrophic error. It paints a massive target on your back for the CRA. The Canadian Income Tax Act has very strict rules governing how you access money inside a life insurance policy. It all comes down to a legal term found in subsection 148(9) called a disposition. Under this section of the Act, borrowing money directly from your life insurance company, known as a first-party policy loan, is legally categorized as a disposition of your policy. To the CRA, that first-party loan is not actually a loan. They treat it exactly as if you are cashing out your investment, triggering immediate tax consequences. The CRA taxes you on what they call your policy gain. To calculate that number, they take your loan amount and subtract your policy's adjusted cost basis, or ACB. Your adjusted cost basis is actively dragged down by a heavy internal charge called the net cost of pure insurance, or NCPI. As you age, this NCPI weight grows heavier, destroying your ACB at an accelerating rate until it's crushed to near zero. Policyholders frequently look at their rising cash value and feel incredibly secure, completely unaware of this invisible internal decay. Because of this ongoing NCPI erosion, the mathematical reality of Canadian life insurance guarantees that tax-free borrowing is strictly temporary. It is not infinite. Let's say you request a $50,000 first-party loan, expecting it to be tax-free. The insurer subtracts your eroded $10,000 ACB, generating a $40,000 policy gain. By law, they report this transaction to the government, generating an official T5 tax slip. You are now on the hook for ordinary, fully taxable income tax on that $40,000 gain. Think about the financial insult of this outcome. You are forced to pay income tax on borrowed money that you literally have to pay back to the insurer, with interest. There is a reason this myth persists online. Ultra-wealthy Canadians do actually leverage their life insurance for cash, but they use a highly specific legal framework called an immediate financing arrangement, or IFA. Instead of taking a loan from the insurance company directly, the policyholder pledges the life insurance to a third-party commercial bank as collateral for a traditional loan. This structural difference is everything. A collateral assignment to a third-party lender bypasses the subsection 148(9) disposition rule completely, allowing wealthy borrowers to legally maintain the tax-free nature of their capital. The core rule of Canadian financial planning is simple. Never import an unverified foreign tax strategy. Taking a first-party policy loan is a taxable event that triggers massive personal liabilities, destroying the illusion of infinite banking in Canada. But the infinite banking trap is only the first misconception. Make sure to subscribe and join us in the next episode, where we uncover the hidden tax bombs sitting inside corporate life insurance policies.